here at Hurley Investments. We're doing the market view commentary on Monday, the 17th of August. It's my grandson's birthday today, so I just got off the phone with him. But it's a fun day. I'm going to start where I left off last week, because I didn't get to really cover in depth. Somebody asked me, it was Nathan, I think, asked me to talk about a trade that didn't necessarily work out great. And I wish in hindsight that I would have said that Palantir, the trade that we were focusing on last week when I was showing you the stock replacement strategy, it wasn't working out great for a long time, and then it did. And so it was because we made adjustments to it that that thing turned out as good as it had when I was showing it last week. But I talked about Walmart, and I promised that I would get some data and go over things, and that's what I'm going to do. But I just wanted to reiterate what we were talking about last week. Paul Tudor Jones, the famous hedge fund guy that made money on Black Monday. Um, his quote was, "The most important rule of trading is to play great defense, not great offense." And I just had to show this little clip of some great defense here in football because it's football season in a couple of weeks, right? Oh, that's one of my favorite plays. So this is the BYU-Utah rivalry, one of the biggest rivalries in the country, and I'm a blue and white guy, and so that that I if you could have heard that smackdown, I was in the stands when that happened, and I you could hear it. It was really great defense. So I'm just having a little bit of fun there. But I wanted to show you a little bit about Walmart. So we got into Walmart, and I got to steal a little bit of credit for Walmart because it is one of the, remember we were talking about 4% of the stocks account for 100% of the gains over the past 100 years. Well, if you take the S&P 500 and that represents the market, there's 20 stocks that we should be investing because 4% of 500 is 20 stocks. Um, and Walmart is one of those. And it's a retail instead of um, technology stock. There's a little bit of technology involved with Walmart, but um, and this is one of my defensive plays. Um, and just to reiterate, we're always thinking on defense, right? We've got some stuff coming up. We've got some things that I've told you in the past I'm worried about. I'm worried about what the Fed's going to do. I'm worried about this current Fed chair, the new Fed chair. He seems to me to be um, undermining the Fed's credibility with a lot of his comments. His thing that he's going to be known for is there's a committee for that. There's a task force for that, that a task committee or whatever. He's always talking about that and shielding the things that he wants to do, which I'm not 100% convinced on, but it just makes me worry about things. Um, and so we think very defensively, and I want to show you so last week I showed you the stock replacement program, which is a bull call debit spread. Um, this week I'm going to show you the collar trade, which it allows us a lot more flexibility and over a longer period of time. And there's things that we can do with a bull call debit spread that we can't do. I'm sorry, there's things that we can do with a collar that we can't do with a bull call debit spread. Um, but you can see here the profit loss graphs. This is a profit loss graph of a bull call, sorry, of a collar trade, of a full collar. Only you buy one, so many shares. In this case, I did 400 for this person. 400 shares of stock. You sell the January 15th 170 call. I think that was at ship down. And you buy the May 15th 125 put, and that gives you a risk of 130.59, and a upside potential of 3,941. So that's a huge upside potential with limited risk, and that's That's the trade that we're in, that we started. That's not necessarily the trade we're in right now, but I'm going to talk about that. Let me pull up a spreadsheet. This is what I this we entered this trade. We started it back in March, and you can see here the trade. These were just taken off of statements. This is the trade that was done. Net debit of 130.59 for one contract. But that totaled out to a risk of $52,000, right? With a max profit potential of 15,764. So that was the original action. And then later on, so we were getting close to expiration. So the first expiration here, now you can't do this in a um, bull call debit spread, right? So I bought May puts, but I sold January 170 call to get into that. Now, if I sold the call in the back month with a debit spread, it's going to tell me you can't do that, because as soon as this option in the front month expires, the back month option becomes a naked call sell, right? That's the most risky trade you can do, whether you're a professional or a retail investor. That's the most risky trade. It's unlimited risk to the upside, and there's really no limit. If you sell a put, naked, your risk is the stock could go to zero. So there is a limit. And if it's a $20 stock, you're risking 20 bucks, whatever the stock price is. But with a naked call, there is no limit. That stock could go up infinitely, and you're on the hook for it. This is the most risky trade. So we don't do that, right? We're not interested in that. But I can raise a lot more money by selling further out expirations, to pay for more protection as I go on if I own stock. And yeah, if you're in a naked put, the risk is, you're right, Nathan. The naked put is the stock could go to zero. But if you're naked a call option, if you sold a call option, your risk is absolutely unlimited. So so we, in this case, we're selling in this case, where you have the shares of the stock already in your account. Exactly, Maud. Um, when you have the shares in your account, I can sell calls against those all day, and it doesn't have to. And as long as I have those shares in the account, I can trade these two positions out however I want to take advantage of market swings. And that's what I'm gonna illustrate today. So if you bought Walmart shares back in May, or back in March, yeah, right around here. Um, that stock has gone down, and you've lost some money. But the way we've handled it, let me pull out a spreadsheet. Here, as we got close to the expiration in May for those 125s to expire, went ahead and sold them, got rid of them. It wasn't going anywhere. Might as well take some money off the table. Got 45 cents back, and bought another put that was the 130 put, because the stock had gone up. So we lost a little bit of money on that put. So we go back to at the money, stock is up a little bit, sell the 130 put. It cost us a little bit. It raised our price. So our net risk in this case went up to 54,000, above 52. So we risked two more $1,000 to get another put on there. And then later in June, it's time to take some profit. The stock moved down quite a bit, and so we sold that put, made 14 bucks per contract here. We bought back the call because the stock moved down, and our call, both both buying a put and selling a call both make money as the stock goes down. And it's funny because we're selling the call to help pay for the put, and they both make money as the stock goes down, which is great. And so we took some profits off of both of these, and that after taking profits here on both of these, we got our costs down to 48,222. So we're actually now at low. We've made a little bit of money on this. We still own the stock. We've made a little bit of money on this, and now we're out of our option position, so our risk is unlimited. We've reduced our break even now on the stock is at 120.68 instead of 130. So we're up about $1,000. And so that's good. Then earnings were coming up in June as well, and we didn't want to be naked for too long. We were naked shares, but we just owned shares. And we were for a few days, 6 days, and then I wanted to get some protection back on there again for the next event that was coming up. I don't remember what the event was, but we got some more protection on there. We sold another call, this time going out to December, the 135 put, and the at the money, or sorry, the 120 put, the at the money put, and the 135 call is what we sold. And I actually doubled up on this because I was worried. I was thinking the stock was going to keep going down, so I actually doubled up on the number of puts that I had. The call that I sold helped offset some of that, so we increased our risk a little bit, back up to 51. Still not worse than our original position. Still doing a little bit better, having a little bit of profit, but now I'm limiting our profit potential to 12,000 instead of 15 at this point. I just narrowed that a little bit and took it out to December and September for the puts. Then things started going well in July. Stock was up a bit. Actually the stock was down. It took some profits off the puts. The stock was down a little bit. And so it's time to take more profits off, and I was able to get out of those for a nice price here. And same with the puts, or same with the call option. We ended up buying back the calls at a lower price and made $1,000 on that. Made about six to seven on the rest of the puts. Now our cost is down to 44,519, which is good, and we're back to unlimited profit potential. All right, and then again we get going on, and we've got earnings coming up. And Walmart earnings are actually this Thursday. So we've got earnings coming up. We're into August. It's starting to get, I'm looking at pricing of options and where they're at. It's time to add protection again. So we'll go ahead and get some more protection. This time back to the one put, one call, did 4 contracts in this case. It ended up costing 2 cents. So the calls almost 100% paid for the puts that we purchased, and now our risk is limited again, but we can still make 12,560, a little bit more than I could here. But then we'll see what happens. So whenever we're selling that call, whenever you cover a stock position by selling a call, you're limiting your profit potential. But we're doing that to take advantage of the market as it is right now, and in high risk areas with earnings announcements and stuff like that. We want to make sure that we can protect that position, because that's the defense we're playing. We just want to make sure that we can do it. The collar trade is a lot more flexible at what I can do, and how we make adjustments over time. When you're doing that bull call spread, you have to make sure that the option that you're selling is in the front month if you're going to do it in different expirations, or you just do them at the same expiration and you take whatever you can get. Sometimes you buy back the call like we did with Palantir, and that turns it into an unlimited position. But in this case, we can roll these options out all over the place and bring some money. So the position that we're in right now still has some value right now. As of the close of today, this position is up 2,500 bucks. So it but when I look at it, right, and when you look at it, even if you look at it in your account statement, it's like it's showing a lot of negative numbers there, but it's not keeping track of the whole thing as a position that's been traded back and forth over time. It's just showing you negative numbers for things that are happening right now because the stock is down substantially from where it was. So, and that's the beauty and the flexibility of our strategy to be able to make money when we're wrong on direction. We think that the stock is going to go up, and this stock is over time a long-term position in Walmart. This thing should just keep going up, right? It's one of the top 20 in the S&P holdings. It's not going anywhere. It tends to perform well when the economy is not doing well because people stop paying more. Walmart's viewed as a cheaper place to get the things that you need, and so they tend to do a little bit better. And that was me playing defense. Why I chose Walmart is because I'm just thinking defensively minded because I'm worried about what the Fed might do, and I'm worried about seasonality, which is the next thing I'm going to talk about. I just wanted to show you this. This is if I if instead of on the same day, instead of doing the full collar trade, I would have gotten into a stock replacement strategy instead. And this is you can see that the profit loss graphs they look pretty identical. The risk in this case was a little bit lower because we didn't have to buy all that stock. But we didn't have the flexibility of making too many adjustments. The adjustments that we made to take profits on Walmart as we went owning the stock, we didn't have the same flexibility in a stock replacement program. So if you did this, it would be a lot harder to make a profit than it was for us to do it on the collar. So I just wanted to let you guys see that. And then I want to talk about seasonality. And so I just need to give a reminder to everybody, right? This is super basic, but it's not something that everybody understands. Um, it's never Your trading, it's never about what happened in the past, right? Earnings, you've heard me say this before, earnings don't matter. Whatever the earnings are, it doesn't matter because that's all in the past. We've already made a profit on that. Where the stock is, if you believe in efficient market theory to any degree, then everything that's currently known about the stock is represented in the stock's price. So when we get earnings, that's just justifying the current stock price as of right now. But the important thing going forward is what is going to happen in the future. That's what matters the most. And I'm going to take this out of just earnings. So in earnings, it's the comments that are being made in the conference call that are giving forward-looking statements. That's what investors care about. It's not what the earnings were in the past. It's what are the earnings going to be on the next quarter report. That's what matters. So I want to ask a question. What month is the worst month for severe market crashes? And if you remember the months when Black Monday occurred, that might help. Right on, Nathan. October is the worst month for big market crashes. Okay, so now which month tends to be the worst month for the stock market? Excellent, perfect, Mod. September. Exact, because everybody knows the worst market crashes have happened in October, so they start to anticipate in September. The market is always anticipating. They don't care what happened in the past. They do a little bit because they know October's been bad, really bad. Um, so they start taking positions that are negative for or expecting the market to start to dive, or they start protecting themselves, or they start planning for bearish positions in October, but they start doing that in September. So they're anticipating. And so September is the worst month for the market. And there's a Fed meeting in September. And I think a lot of the times that the market's gone down in September is after that Fed chair says something in September. Um, Let me look, let's see, Abraham, QS chart, USPX, I'm guessing. Oh, chart style, seasonality, chart mode, seasonality. I don't know how to read this chart. I've never looked at it. I'm just looking at it because you told me to do it. Yeah, I'm not sure how to read this chart. I've never really looked at it before, um, but I've been trading for just about 30 years now, and I've learned to be very careful around September as September rolls around. So it has me worried uh, for sure, and and especially where we're at highs. If I need to go back to this chart style, chart mode, standard, because we'll be looking at these in a minute. But that's to me, that's flattening out, trying to form a spot of resistance. Right, we're near all-time highs, and it's kind of flattening out as we get ready for September. We'll talk about that here in just a sec as well. Um, yes, so this was October, and the market anticipates in September. Um, these are some earnings that we're watching really soon, right? Uh, here's here's Walmart. We've got Nvidia coming up too, not next week, but the next week. Same with Micron in September, end of September. Marvel's out there pretty soon, week after next. Briefing.com has been talking about things, information technology. It's funny because the one week they were talking about shorts going on and everything like that, and I completely disagreed with that article a lot. But now they're back up. Now they're back on. The information technology sector has been the S&P's undisputed heavyweight, accounting for 37.9% of the index after years of market-leading performance. Information technology and communication services are the only sectors carrying more weight today than a decade ago, while the other 9 sectors have all lost ground. So why would you invest in the other 9 sectors? That's what I always, right? We want to be there. The September October effect. It's just after the summer doldrums come around, people start getting back to work. they start examining things a little bit closer. I'm not. It's not always the same thing. Sometimes it's the Fed. Sometimes it's interest rate policy changes. Sometimes it's just the economy and the seasonality of the economy and things that have happened in the past. It, some people, if people invest in commodities and stuff like that, it depends on the weather during the summer and how much uh, the commodities are available or they're not available, and that goes into supply and demand figures and stuff. So it's never just one thing, but it's definitely a seasonality that happens. So that's a great question, Abraham. But I don't think you can attribute it to any one thing. In fact, they like Black Monday. They have if you want to have a fun time, research what was the cause of Black Monday, and you'll get a whole bunch of different answers that you can go through, and it's probably a combination of all those things, which it always is. Um, I like that this briefing article is talking about the AI trade as a major catalyst for the stocks breaking up to all-time highs, and then that brings up the concern of maybe it's a bubble. But I like this comment here. Anything is possible, but the reality today is that investors seem to have their minds and their allocations heavily weighted towards information technology sector. And you know what? That has been a very profitable orientation. Yes, we know that, right? We know that. If money starts coming out of information technology, where might it go? Now that's something that I'm always concerned about. Whenever I place a trade, whenever I'm looking and I come to a conclusion, oh, this looks like a great stock, my very first question before I push any buttons is, what does the market know that I don't? Because one person, you just can't know everything that there is to know out there. And there's information out there that's yet to be known. Um, and that tends to drive stocks. So you typically find out about that information that's not known during earnings reports, conference calls around earnings. That's where you find out a lot of that stuff, right? So that's why we protect around earnings. Um, and then you can see how things go and make adjustments to your position to help you make money regardless of which way you think it's going to go. You can if you were wrong, you can still make money on the position. Um, they mentioned the information tech solid the stocks that we own. There's one here that we don't, which is Microsoft. But the others where we have positions in. And you just look at the technology, right? This is just for the last year, and you can see the weighting in the index of how much of an effect it has on the index. Um, and it's been going that way for a while. I don't know if you so even if you went back, there was a guy at the University of or sorry Utah State University um, who I'm just thinking about why is it technology that is the big carrier of the index? Why is it the outperformer? Um, and it's whatever innovations, that's where innovation happens, and that's where things come that make things more efficient, and that's where things come that so this guy at Utah State University invented a new um, oh a new kiln technology for making pottery. And if you think about it, how long have people been making pottery? For thousands of years. And this guy came up with a new kiln that's more efficient, that has less breaks, that it's just a better kiln on something that's been going around for thousands. So if he would have invented this when the stock market first opened and there was a big pottery market that could use it, it would have been a tech stock, right? We look at it now and it's like, no, that wouldn't be a tech stock at all. There's no computers involved. Um, I don't know if he used computers to design it or whatever he did, but he invented the technology. It's a kiln and it works better than other things. And then he just open sourced it and gave it away. and to anybody who wants to use it, which is kind of cool. Um, but there would 1,000 years ago there would probably be money to be made if he was helping. If you think about the Chinese pottery and stuff, and their glazing tech, all the beautiful things that are really valuable now, that would have definitely had an effect. Um, but so to me, it's information technology is just where things are being innovations happen. Um, the information sector has been eating well for a long time, and there's no reason it can't continue to do so. That's exactly how I feel. Secular drivers behind technology spending, cloud computing, semiconductors, and artificial intelligence remain powerful, and the sector is populated by some of the most profitable and innovative companies in the world. All right, so we're in the right place. Um, Yet the S&P 500's current concentration suggests that it wouldn't take a wholesale abandonment of technology to provide a handsome lift elsewhere. So I'm always looking for that too. Um, I don't think of Walmart as a technology company. I think of them as a logistics company getting product from one point to another, and they're using some technology to do that. But really, I see them as a logistics company. Um, but they're in the top 20, right? So they're not in the necessarily in the technology. They're in the retail sector is where they would be, where their stock would be listed. So I'm always looking for other places where we can get some of that too, especially if there is some kind of a pullback in investing in AI or something like that. It's nice to just have something out there. Where would things go if the AI bubble does burst? Where would things go? Um, I typically go to tried and true places, right, that are not going to die while we wait for the next innovation to come along. Um, So let's get into charts. You can see here. So the Dow Jones Industrial Average is a little bit flat too, but it's leaning more down than the S&P. Um, Here's one of the things I want to point out here with the S&P. It's flat, but implied volatility has just dropped a lot. Some of you that have been with me for education related stuff forever, you know what I think when I see implied volatility get extremely low. That's a sign that it's going to revert to the mean, right? It's going to come back up here sometime soon, usually within the next 3 months. And so that, and whether that's that the implied volatility coming back to normal or switching to the other side, it can happen very fast, um, and it's not directional. It can be bullish or bearish as it reverts to the mean. So that's just interesting coming up. Um, Nasdaq is a little bit flatter than either of the other two, and same situation. We're just kind of I think the market's pausing as we get close to September, the beginning of September. I think everybody's kind of wondering if they should start taking some profits at this point, or are they adjusting their positions to try and be ready for what's coming in September. I know there's a lot of hedging going on, so we'll see what happens. Where will the SPX end August? Probably higher, because every week so far has been higher. So I think that we will end August higher, but I think that the technical patterns are trying to form a top, and I think people are concerned about September being the bearish month. So we'll see what happens there. It doesn't mean that our stocks have to be bearish during that time period. Our stocks could hold up nicely, and the S&P 500 could go down. So we'll see. We'll see how that plays out as we get there, because I have no idea what's going to happen. Nobody does. We have earnings coming up. Baidu is an issue. We've traded that stock plenty of times before. Toyota's coming up. Walmart, Alibaba. Walmart, I'm going to be watching like a hawk. We're protected. We're fully protected on that one for earnings on Thursday. Um, so that's good. Economic reports that are coming out. FOMC minutes on Wednesday. I think we're going to see just the number of people that voted to raise interest rates at the last meeting. I think we're going to see that there were some pretty good arguments going on there. So we'll see how that happens. And I'm guessing that through that whole thing, our new Fed Chair Warsh was saying, we gotta wait for the task force to report back." I I don't know. I don't know what we'll see, but I think that that's something that we'll be paying close attention to um, on Wednesday, and so it'll start trading on Thursday. So we'll see what happens there. How am I looking to trade? I'm looking to add position. We have a few positions that don't have protection on quite yet, um, but I'm looking to add protection at a low cost before we get to September. So we're kind of in that area where we're looking at cost to make sure that we're getting in the right position before September rolls around so that we're protected against anything that happens. And we've still got earnings coming out for quite some time, so we'll be looking at earnings. All right, any questions? I'll just wait around a little bit to make sure we got everybody's questions answered. I wish there was an answer for the September effect. Um, I wish there was a clean, clear answer, but there's just not. I've heard so many different explanations, but awesome. Thanks, Tony. You're welcome. I'm happy to help. Yes. Are the midterms getting factored into the market yet? So that could be another reason why September. So that is another reason um, why September, October is because people say they're trying to anticipate elections. That is another reason that people have given in the past to say for the September, October effect because they're anticipating elections. Um, yeah, and and just to talk about something else that's kind of interesting is some of you have meta positions, and um, and we can see different things out. So the big news thing from Meta is this lawsuit, this California lawsuit, alleging that they're targeting teenagers for nefarious purposes or whatever. And is like, my goodness, you guys, somebody's looking to blame their child's bad behavior on someone else. And it's like, you're the parent. uh, I'm not we make things we're targeting humans for our position, for our platform to use our platform. And so we expect all humans would like to do stuff on there. If your kid's doing things that you're not happy with, you should take care of that. That's my opinion. Um, I don't think that public companies should be held responsible um, for bad parenting. Um, but you know, we'll see how that comes out. I'm a little bit worried about that with Meta, but I'm not too worried about it. I think they'll be able to. figure something out. It's like, well, we have parental controls. So, yep, awesome. Yeah, seasonality can be helpful. It but it's not always because it's not every year, right? So it's just something that you need to be aware of. But it can be different. It doesn't always pan out that way. Have been Septembers and Octobers that were good up months. Um, but it's just the the large majority of Septembers and Octobers um, tend to be a little bit bearish. So we'll see how this year turns out, and it might not affect our stocks or our holdings at all. So we'll see what happens. But yes, there's plenty of bad influences out there, huh, Lee? Yeah, it's just easier to get to bad influences on the internet than it was in the past when you had to go to a shady side of town. Um, yeah, yeah. Good point, Nathan. Nothing in trading is always, but there are probabilities that are worth trading. Yes, and I really like trading straddles, and I love trading straddles as we get into. I like to have my position set before we get to September, October, um, because those can be some big moves in that month and potentially profitable. So, and and this type of trading where we get the flexibility to make money in either direction, whether it goes up or down, is very helpful. It's just like having a straddle position on. It's similar. It's similar, but this one's a lot more flex. This way's a lot more flexible. If you buy a straddle, you're limited to that time frame, and you can make some adjustments and roll your position to take profits off and things like that. But it's uh, it's a lot more. It's it's more time sensitive than the collar trade. So cool. All right. Well, I got to get going. I've got some other stuff to do, so I'm going to let you guys go. I hope you have a wonderful weekend, and we'll see you back here next week. And I believe Kevin will be teaching next week, so we'll be back. Talk to you later. Thank you. Bye bye.